Okay, guys, go for it.
So we wanted to start from the foundations, from the beginnings. So we would like to tell you about differences between debt and investment and equity investment. So which one of you want to tell us something of advantages and disadvantages of debt financing?
Okay, I can start. Hello, everyone. Thank you for being here, and thank you for the invitation. Well, the obvious advantages of the debt financing is that you, as the entrepreneur, as the founder of the company, do not have to share your equity with the investor. Also, in the case of debt financing, the whole process is much quicker than applying for finding investors for a or second round of financing. In case of, but also there are very obvious disadvantages. Primarily in the case of debt financing, you get a loan which you have to pay for, you have to give it back. The capital, you have to also pay the interest, so it affects your balance sheet, affects your cash flow. When you look at the other alternative, which is equity financing, you get money that you do not have to return, so it's a big advantage. You get the money which improves your balance sheet, so you can apply for debt financing in the future. But you go into the process, which is much longer. It takes much more time to acquire equity financing. It's more expensive in indirect costs. You have to go through due diligence sometimes. You have to pay for the lawyers. You have to prepare the whole process. You have to travel. So when you look at the indirect costs, the equity financing is takes much more time and it's more costly.
Okay, and in early stage investment, which is a specific type of investments, what is more suitable way of financing projects? In projects which are not generating revenue or even are in the seed stage?
Well, in order to get debt financing, you should be able to repay it within a time frame. So depends very much on the company. Where there are companies that can generate significant cash flows in relatively short periods of time, perhaps they can apply for some sort of debt financing from selected institutions which support such early stage companies. This is of course very rare. Normally such facilities are not available. They're only available because EU funding or some other intergovernment funding allows this kind of facilities to exist, which means that it's good to make use of them if they have come up on the market because they provide significant advantages also to equity providers. Equity financing is the most suitable form of financing for early stage and startups. However, equity investors often want to have some sort of privileges over the regular founders, and that leads them to be less equity and more on the debt side. But this very, very much depends on the negotiations and the type of company we are talking about and the type of cash flow generation that it's able to generate.
Well, our predecessor, Director Bańka, told us about a loan fund that PARP has started, pilot of loan fund in 2013. You, Paweł, had one company that made use of that fund. Could you tell us your experience from that? Because I find applying for a loan for a startup which is not generating profit, revenue even, very troublesome. So what do you think? How do you do that?
Okay. With great pleasure, I can speak about my portfolio company. It's a great, it's a great case as an example. My fund invested in 2014, a year ago, in a startup which has a great innovation in designing and manufacturing flight simulators for general aviation. The company is called Techsim. My fund invested 1.2 million zloty, which is about 350,000 euros. This particular firm just finished its R&D project, which took them about 3 years. And they were looking for additional money to finish, to build the prototype and to go to trade shows to show the product to the public. The total cash flow need was about 3 million zloty. For me as the fund to invest such money was much more difficult decision to make. And for the founders, they were not willing to give a lot of equity or a lot of stake in the company from my equity. So we went outside and tried to find a debt financing to finance part of the project. Of course, the company could not apply for bank loans yet, since it had no revenues and had only losses because of R&D, and it had no fixed assets like properties, buildings, or equipment. So we turned into PARP, we turned into Polish Agency for Enterprise Development. We applied for the loan for innovation. The process was much easier than I expected. It was not that regulated as I would expect. The whole process took about 3 months since submitting the application to the signing the agreement. The company obtained 2 million zloty, which was twice the capital that my fund invested, for the period of 6 years, with 2 years of nie wiem jak wakacje kredytowe powiedzieć, with 2 years of period in which it did not have to pay grace period. Thank you very much, Kinga. And for them it was a great jumpstart to finish their financing of prototype and go to the market. So it was a great alternative how to convince the investor to put the equity, on the same time not to share as much of stake in the company, and to finish the product to bring it to the market. So it was a great example how to get the financing for the company which was not able to get it on a commercial basis. We'll see how the project ends. For this year we expect already a few million of revenues. The company had money to go to the trade show in Germany, which was a great success. We hope to get break-even between this year and next year. So I hope it will be a great success story.
Okay, thank you. We didn't expect that, but okay. So we can go down to business. Please, Kinga, tell me, what are the attributes, characteristics which can tell us if loan or equity is more suitable for a particular investment?
Well, to me, if it's a fast-growing company which does not expect to generate cash flow in the foreseeable future, that investment is not suitable. That financing is not suitable. It's suitable only if cash flow projections allow there to be sufficient free cash flow for the service of debt. Otherwise, it's a killer because the company can never pay back and you go into restructuring of debt. It doesn't make any sense.
It's obvious. If you don't have money, you can't pay up the debt.
So the most important thing to look at are the cash flow projections. This very much depends on the type of company you are, because if you're a technology company that is aiming all the time to upgrade technology, the IT side of things, the software, the UX, and so on, and at the same time you're going to spend a significant amounts of money on marketing, you might not be generating enough EBITDA to be able to cover the cash flow, the cash flow needed for debt repayment. And this is a problem. But then it's good to always look at the mixture of debt and equity, because this is maybe what we should be talking about. Not pure debt, not pure equity, but a mixture of both. And what are the advantages that you can put together of having equity with debt support? Whether that equity can generate more return for the founders and the fund with the support of debt. And those are the most interesting cases. So it's possible to have debt financing go together with equity, and if the cash flows are insufficient, you may need to raise further equity as you go down the road in order to be able to start repaying the debt over a period of 2 or 3 years, and that may well be the case. It's very difficult to project good operational cash flow from early stage companies, so you have to be pretty sure as to the commercialization aspect of what you are doing. You need to be sure that the ARPU you're generating per customer, you need to be sure that there will be limited costs of operations, you need to quantify the cost of marketing. These are very important aspects in terms of your value proposition for the debt provider. And only once you're able to quantify these, it makes sense to seek debt financing. I think debt financiers are very careful in judging the creditworthiness of companies. They need to look at the projections in great detail to be able to have a level of comfort that the company can actually repay back, and this is the key thing.
Can I?
Yes, of course.
It was a great point, Kinga, that you pointed. Actually, I can provide an example. My fund invested a few years back in a young startup. It's a manufacturing company. They needed cash for finishing their investments in fixed assets, in building, equipment, building. They were not able to get additional debt financing from the bank. They had already one loan, which they received as a startup because it was an investment in fixed assets, which is much easier even for the banks to provide. But because of the balance sheet, they couldn't get additional financing from the banks. So what we did, our fund said that we are able to provide 3 million additional equity if the company will get additional 3 million zloty, the same amount from the bank. The banks, we started the negotiations during the same time with the fund, and the company started the negotiations talks with the bank. And the bank was able to make the decision to provide additional financing, but with one condition, that the investor will provide equivalent equity to the company in form of cash. And at the day that we paid the equity to the company's bank account, the bank started the loan, and it worked. So exactly as you said, but it works better in offline businesses or traditional businesses. We're able to mix the equity with the loan, and as the result, the company was able to get, as the result, 6 million zloty of equity, of capital, I'm sorry, for the investment. It worked great.
Okay, so we touch a thing I was going to ask now. So is area of the operation of the company any factor of this whether we invest loan money or equity, the industry branch in which operates a company?
I guess it's the type of company it really is. For that, you usually need two things. One is cash flow generation capacity, and the other one is some sort of assets that the debt provider can usually have some sort of leverage on. Usually debt providers are looking for pledges on various assets, shares, or something that they are able to get loan repayment in case things go wrong. So I think that the companies that are most suitable for debt financing are either heavy asset companies that have something that is able to act as security, or alternatively something which has great cash flow potential. For example, the first one would be a factory of some sort, something which has a building, which has real estate, which has machinery. On the second part, it would be something that generates cash flow very quickly and with a high margin, with margins of 40–50%. Then these are easy companies to finance on the debt side. For an example of the second type, you could be looking at consumer finance. This is a great company usually to finance with debt because the margins are so high and the turnaround of the money is so quick that debt providers feel comfortable to provide debt even to early stage consumer finance players.
But when we speak about various forms of debt financing, we have to name them. If you are a startup or any company, if it's a heavy asset company, as Kinga said, or maybe even an IT company, if you generate losses, if you are not positive on your profit and loss statement, you are not able, at least in Poland, to apply for a loan, for a debt financing in the finance sector. So then you are, the only option that you have, you either are looking for a private loans, or you go to Catalyst, which is a public market for corporate bonds, exactly. But you are excluded from the bank system. Unless, as Kinga said, you are working in a sector with very high margins, unless you have already signed contracts, and you can go to the banks and say, okay, I have high margin product, I have already stable or guaranteed revenues in form of contracts, yes, and I apply for a project finance, but usually it's a product for larger corporations and startups.
So I think we can state it clear that if the company is on the start of the journey to huge money, the only way to gather external financing is to share the profits, share the company.
Share the risk.
Yes. So I think we said enough. Would you like to add something? Because I want you to summarize the point-by-point way to gather external financing from the very beginning to, I don't know, IPO. So which of you would take the task?
Okay, so companies usually start with seed capital, and seed capital is usually your own capital, the founder's capital, the capital of family and friends. Usually people say that the first investors in company are the 3F, families, friends and fools, which might not be the case if it's a good company, obviously. And that's the seed phase. At that point, it's quite good to go and talk to funds, because at that point, incubators become interested in you, angel investors become interested. It's a good time. You have nothing but a piece of paper, you have some money, and you have a team, and you think you're able to deliver. That's a good time to really go and talk to investors, because as the company moves along, you might be stuck in a phase where no one wants to talk to you. This is what happens when you start delivering, start creating a solution, start creating a product, but you haven't finished it. The problem there is you've already collected the money from your families and friends and your own, and you've run out of money, and you're halfway done with the product. Now, nobody believes you that either you're able to finish the product or that you will be able to sell it. That's the worst time to raise financing. This is called bootstrapping, and then you're trying to put in more and more of your own or from your friends, and this is usually a dramatic disaster. So if you know that you're able to deliver a full solution, which is commercially sellable, then that time you jump to the next stage, and then you go and talk to something which is more like a VC fund. And a VC fund will be, largely speaking, looking at a product or a solution which comes in a package with a team, where they can see where the vision is, where they can see what the next step is, where they can see that there's a market for the solution out there, or the product. And there's a bunch of VC funds you go and talk to, which obviously take a minority share in your equity, which can then team up with institutions like PARP that provide the debt financing at that point. And then off you go towards the commercialization. And here it depends very much on the type of company you are, but you need to start to sell. If you don't sell, then really you're a failure, because you need to sell something. There's very few companies like Facebook that don't really sell anything for long periods of time and that are able to survive with new equity injections. Usually you need to think how you're going to sell the product or the solution, because your investor wants to make money on what you do, and the way to make money is to have sales and revenues. So as the company grows, you have your first clients, which means that you have proof of market. And that allows you to raise further equity financing from the next and next and next round of equity investors until you go to either a sale to a private equity, which means you're generating cash flow, or you go to a sale to a strategic investor, or you can go to an IPO. Lots of companies obviously dream of IPO because they think that this is a way for the founder to keep control and stay with the company. The venture capitalists don't always like IPOs. Sometimes they just prefer straight exits. And the strategic exits on the other side usually want to buy 100% of your company because they want to merge it with what they have already. So there's an exit out there somewhere usually, and that's one of those three ways.
Well, it's hard to add something to this great summary of Kinga, to be honest. I would like to mention one thing that was not in the summary, the EU subsidies. Because on one hand, it's a great, one of the ways to get the cash to finance your projects, especially as a startup. But on the other hand, me as the manager of the fund, I saw too many cases of the startups that apply for the EU subsidies. They got the subsidies and then they do the rounds of going to the incubators or VC funds. And they sell the idea that the biggest value of my company is the fact that I got the subsidy. So I think it's not natural. I think that too many founders in Poland, especially in Poland, they think it's the greatest value in the company, the fact that they were able to get the subsidy. To put it in perspective, my fund until now, we have not invested in any company which at the moment of our investment had any kind of subsidy. I have in my portfolio, most of my companies in my portfolio never got any subsidies, and still they are able to exist on the market and make profit and grow their business. So my observation is that too many startups, they focus on getting the subsidy, they spend too much money on getting the subsidy, and then they try to prepare the projects which are not market focused, but they are more focused on getting the subsidy by itself and getting the cash back from the subsidy. So to me, it's more like a disadvantage than advantage.
Okay. Thank you for your knowledge, for this that you told us that things, auditor is not huge, but I think some of them would listen and take to the heart. Thank you for your knowledge and thank you.
Thank you.